Let's welcome Nicole Green.
Hi, everybody. I'm gonna go ahead and share my screen. Okay, so yes, we're going to talk about taxes, and I know taxes can be a little daunting for people, but taxes are so beneficial and change how people look at their goals and look at their opportunities. It really can expand what you're able to do. Okay, so first let's get into me. My name's Nicole Green. I have been doing taxes for about a decade. Before I was in taxes, I was in education. People think that's the craziest jump to go from education to taxes. It's not. That's what taxes is education. We educate our clients. Our tax codes are constantly changing, so I'm constantly being educated and having to go out to get education. We here at the firm do education for our support staff. Like it's just education all around, and I love that as an educator. That's one of the things that makes this so much fun. I work with Robert, or work at Robert Hall and Associates. Robert Hall himself was an educator. He was a teacher. His wife was also a teacher. So again, that whole education thing is really drenched in this firm. As one of the reasons why I love this firm is also one of the reasons why we are still around and flourishing. We've been around since the 70s, way before I was born. Just making that very clear. We service California, all of the United States, and even a little international as well. I do have quite more clients than people would expect that live abroad. What we do is we really do tax strategy. We are really into tax advising. Yes, we prepare taxes because I need to make what I told you to do work. And so we prepare the taxes, but that's just like the secondary thing that we do. We're really into giving advice. And yes, it happens usually during the tax appointment and stuff, but sometimes not. Sometimes it happens in other appointments. But we're all about helping people utilize their tax returns. If you really think of it as a tool and not this annoying thing that you have to do, but if you think of it as a tool, you can realize that it's a powerful tool. And if you want to sharpen this tool, you can really exact your goals and cut them out really kind of cleanly. And so, because we give tax strategy, we want people to go out and do what we say to do, the strategies they come up with. So, we do several things in house, bookkeeping, payroll, etc. But if we don't do it in house, we work with great partners and have a huge referral network for us. Going back to the education bit, we offer free 30-minute consultations. We truly believe that the smarter people are, the better decisions people make. And so we offer these free 30-minute consultations. I always tell people it's like accountants, doctors, attorneys, and mechanics. As soon as you run into one at a party or anywhere, you're like, oh, can I ask a question? Like, and me personally, you can ask me questions all day long. I love it. I don't mind. But sometimes I need to get a little personal. And so, like, I need to actually see people's tax returns and things like that. And so, these are really great ways for people to ask just general questions. I get people to come in and be like, hey, I just want to know about this. And I'm like, okay, I can answer that really quickly. And so, we offer these free 30-minute consultations for anybody and everybody. There's no requirement for them. If you'd like one, you can go to our website, roberthalltaxes.com, or you can email me directly, nicole.green@roberthalltaxes as well. I just want to let everybody know I'm licensed with the federal government. I'm not licensed in California. I'm licensed by the feds, which then trickles down to all 50 states. But this is not real estate advice. It is just tax advice for educational purposes. Everybody's goals are always and obviously to lower your tax liability. That is given. That is granted. That is given. Other people, you also have additional goals that are going on. Like, are you trying to buy another property? Is your kids getting ready to go to college? Like those other things, your mother-in-law is going to move in, your family members having a ton of medical expenses. All of these things can be a part of your life, and your tax returns can affect and help those things, either directly or indirectly. And so we like people to focus, first and foremost, focus on reducing your tax liability as much as possible without pulling in external things. And that's just including what you're spending your money on already. Before you're like, hey, should I go buy a car because I heard you can write off the whole car? Or should I buy a new laptop? Or what if I need to rent this off? Wait. Before we spend more money, let's make sure the money that we're already spending is being counted appropriately. And so I tell people, you're going to ask yourselves two questions. Well, you're going to ask yourself one question. And if the answer is yes for the one question, then you'll have a secondary question. But your first question you're going to ask yourself is, am I using this for business? If the answer is yes, then you should go out of your business account and it is going to be a deduction. That expense is going to be a deduction. The follow-up question that you're going to have is, how much of it am I using for business? And that will determine how much of it can you deduct. And this will go a little bit into how you're structured as well, whether you're structured as an LLC, single member, sole proprietor, or nothing, or are you structured in a partnership, or are you structured in an S Corp or a C Corp. But regardless of how you're structured, if the answer is yes to the first question, am I using this for business? It will be a deduction. And if you just generally ask this and don't labor, don't get like super intense with it and be like, well, da da da, and just keep it really simple and really basic, then you can go ahead and easily categorize your expenses. Because I know a lot of people, when they're like, oh my God, I'm going out on my own, or now I have 1099 income, they get kind of stressed about like, I don't know what can I and can't I count. And it's like, are you using it for business? If the answer is yes, we are going to count it one way or another. And then it's how much of it are you using it for business? Let me give you some examples, right? You're going to go buy a new laptop. Your other laptop is good, but you want another laptop. So are you using this laptop for business? Of course, you're going to use this laptop for business. We're going to go ahead and deduct it. You have two laptops. We just said your other laptop isn't great, but it's fine. So we can assume that this is going to be the business laptop and the other one's going to be the personal. So regardless of how we're structured, we're going to deduct the whole thing, because we can go ahead and say like, hey, personal and business. Your car. Are you using your car for business? Yeah, you're going to use it for business, right? And if you're sole proprietor or single member, whatever, if you're doing it all on your personal return, you can do miles or you can take the straight car expenses. I tell people in that situation, track both. We're going to talk a little bit more about car deductions a little bit later, but track both, because we want to take the highest of those deductions. If you're not using your car fully for business, then we will go ahead and proportion out how much of it. It's very easy to say 50%, 10%, 30%, whatever it is that you're using it for business. If you're an S Corp and if you're using the item 51% for business or more, we're going to be able to take that full deduction. And so like for the car, for the laptop, if all of that, if we're using it for business 51% of the time or more, you get that whole deduction, which is really, really nice. People give me the example, my house, like how do I include my house? Can I take my lights? Can I take da da da? And again, it's the same theory. Are you using it for business? How much of your house are you using for business? We're going to be able to take it, whether it's business use of home, rent backs, whatever it may be. There's going to be a way for us to get into it. Okay, I want to talk about depreciation, because the government, any state, they love three types of things. They love families. You can see all the credits, all the things, lower, higher standard deductions, everything like that for families. So they love families, they love business owners, and they love people that own real estate. And if you really think about like what society means and like the crux of it all kind of makes sense. Like, why does the tax code kind of favor these three different types of people, or maybe one person that meets all three different categories? And so it kind of generally makes sense. Now, with real estate's been proven to be the best, strongest asset over time that has ever existed in any country. And it is such a gold mine, and it is such a great asset for people to have. And so when you have real estate and you have real estate that you're using for business, I'm talking you're renting it out in some way, shape, or form, whether you're renting it to yourself, you're renting it in some way, shape, or form. I'm not talking about your primary residence, and I'm not talking about a second home that literally you just go to on the weekends or something like that. For business use properties, you are going to have what is called depreciation. And please forgive me if I'm explaining this and you're like, I already know what depreciation is. But just in case so that we have a cute little refresher before I get into like the larger concept. Depreciation is when you have an asset and you spread the value of that asset over time. And so like when I buy my laptop, I bought my laptop for $3,600. That's not going to be depreciated. We're going to take that laptop as a straight expense. It's going to be 100% deductible in 1 year. You buy your car for $100,000. Okay. I bought a laptop for 36 and I bought a car for 100. But okay, my example, whatever. I bought my car for $100,000. That's going to be depreciated over 5 years. So each year I'm going to take $20,000 of a deduction for my car as long as I keep it for those 5 years. Why is my car depreciated over 5 years? Because that is the particular amount of time that has long been set by GAAP, general accepted accounting principles. It's not me that comes up with the timelines. It's not my boss that comes up with the timelines. It's not the president that comes up with the timelines. It's already set with timelines of what things are. And so when we have real estate, residential properties are spread out over 27 and a half years. So you buy $1 million property, 300 goes to land, can't depreciate land, 700,000 is going to be spread out over 27 and a half years, and you'll get that deduction. So this is one of the reasons why most rentals on your tax return show up as a loss. And that's why rentals, again, chef's kiss, we love rentals, because while on your tax return, it shows up as a loss, in your pocket, I'm trying not to say pocketbook because that makes me sound old. I always use pocketbook here. But in your pocket, it is actually going to be a profit. So all of that profit that you're getting from the rental is tax-free. It's just good money for you. One of the many benefits of rentals. Well, that's nice. That's amazing. Certain things have what we call bonus depreciation, and that's where you get to pull the depreciation forward. You, instead of taking a little bit over 27 and a half years, I want to take the majority of it in the first 3 years. You get to accelerate the depreciation. Instead of taking that $100,000 over 5 years, I want to take that $100,000 in 1 year. Now, depending on the item it is, and depending how long the timeline it is for it to be depreciated, there are different rules about the depreciation. But anyway, you're still accelerating it quite a bit forward, and it's most likely going to be within the 1 to 3 years that you're going to be able to utilize this. This is the beautiful thing of bonus depreciation. Whether we can take 100% of it in the first year or not is a law that's been phased in and out throughout time, and I don't really want to get too much into it. I'll talk a little bit about it later, but you will, even when that law goes, when it completely sunsets, there's still always going to be depreciation or bonus depreciation. You're always going to be able to accelerate that forward. Just maybe not all in the first year. It might be the first 3 years. And that's a really cool thing. And so if we look at the house, and the house has to be spread over 27 and a half years, I can do what's called a cost segregation study, and I can go hire a licensed person to evaluate the house, and they go through and they say, you bought $1 million house. Yes, 30,000 of it we're gonna, or 300,000 of it we're gonna attribute to land, 10,000 of it we're gonna attribute to windows, 5,000 of it we're gonna attribute to the refrigerator, 40,000 is to the carpet, and so forth. Well, the windows have a timeline of 15 years. The refrigerator has a timeline of 5 years. The carpet has a timeline of 10 years. And so all of those have now timelines that are available for bonus depreciation and aren't stuck to that 27 and a half years. And so I get now accelerated depreciation through a cost segregation. I'm going to give an example of what a cost segregation can, like how it can benefit and what it can look like. So here, this person has rental, got W-2 income, blah, blah, blah. But they also have rental income, and the rental is showing a profit of $33,000. Okay, that's fine. Maybe the properties are just high rental income. Sometimes short-term rentals can show profits quite a bit, quite easily, because you have a lot of income coming in, or if you're like close to a stadium, or like if you're on the beach and you're renting that out, like those types of rentals really do show quite a bit of high rental income and may show profit. Great, fine, no issue. Well, this person has $33,000 of profit from the rental. They have a total tax on the federal side of $20,850, and so that has them owing $4,000. We don't really care if you owe or if you're getting a little bit of a refund, because owing is just, did you prepay or did you not prepay? Like the bill is what we really care about. So that 20,850 is like that real number that we focus on, and that's the feds. On the state side, they have a total tax of 8,100, and so they owe another 4,000 to the state of California. Let's say they did a cost segregation study. That cost segregation study allowed them to accelerate almost about $45,000 of depreciation. So they're not showing that $33,000 of positive rental income. No, they're showing a loss of $11,000 that you get to take. And so that reduced that 20,800 of federal tax. It reduced it down to 11,600. So not only did it cut their tax, they don't owe, they're getting nearly a $6,000 refund from the feds. On the state side, it takes their tax to $2,500. So instead of owing $4,000, they're getting almost $1,500 back from the state. This is, love this. Obviously, you want your money back, but this is something you do for strategy. This isn't just like, great, let me take this tax savings, book a trip to Cabo, or I don't know where you want to go on vacation. No, we're not taking the tax savings and doing that, because we accelerated depreciation. We did not eliminate that. We just moved the deduction forward. And so what you do is you take this tax savings. Here, the tax savings is good, really good. We love it. It's fine. Great, great, great. But it's good. So we are going to have to wait probably for 2 or 3 years doing this. Now we've saved these tax savings for the last 2 or 3 years. We go and buy another one. We do another cost seg. And you keep doing this. So now you've tripled, quadrupled, 10x your portfolio, starting from one property doing this. You're not putting any new money into it. You're taking your tax savings and you're going and investing and getting another property, rinsing and repeat. Yes, you are just delaying tax, but in my world, especially because the tax code changes quite often, we greatly, greatly believe delay, delay, die. Because when you die, it goes away. So delay, delay till the very end as much as possible. That's how we kind of look at it.
This is some cool, exciting stuff. A lot of talk about saving and thousands, and it's definitely getting me excited. I have a question from Carlos, if we can bring that up. So he's mentioning, I think he's referring to about the write-offs you mentioned before you started talking about the cost seg and so forth. He mentioned, is this write-off strategy best utilized if you have an S corp or self-employed, or does it apply equally to LLC owners?
No, it applies to anybody who has a business.
Got it. Okay. Would it be different? Like, can you write off the different things if you do have different entities, or not necessarily?
It's not about, no, not necessarily. It's not about what we're writing off. It's about what you're actually using. If you're using it for business, we are going to write it off. Period. The end. Whether it's on your personal return, whether it's on a partnership return, whether it's on a corporate return, or whether it's on an S corp return. If you're using it for business, it's going to be written off. How much of it and how it's counted will change depending on the entity structure you have. Like if we have the car, for example, we're gonna probably, and you're just a Schedule C, maybe miles might be the best way. You actually have options. If you have a car and you have an S corp, if you're using it for 51% or more, I'm taking that whole deduction.
Yeah.
Taking straight expenses too. So,
So it is deductible. It's just how it's presented, like you mentioned. That's a great idea. Yeah.
Yeah, but it's not going to. I mean, yes, you can be more aggressive depending on the entity, and I'm actually going to get into now like why you can be a little bit more aggressive on some entities versus
Hmm.
other entities. But and then you're also a little bit more free in terms of like, hey, now you can take everything versus not. But if you're using it for business.
And I'm sure there's certain entities better than others. Obviously, those are things you can discuss with the client on a one-on-one basis because it's got to be curated and custom to that person's needs.
Yeah,
And
because I mean, you don't want to just go into something about the deduction. Like I always tell people, yes, we want to lower your tax liability. I know that, but if you're not telling me the full picture, you're not telling me that you're trying to buy the house in the next 2 years, and I take your tax liability down to $1, you're totally screwed. Because simple things. Instead of taking a deduction here, I depreciate that asset. Now that counts as income. It helps you get your property. There's little things that people can do that help further your goals. We claim your mom as the dependent. Now you can count her medical expense. Like there's ways that we can do things to help people's goals. So yeah, we need that full picture so we know what's happening so we can help tell you like, yes, this is. And then there's also carrying costs, right? Like having different structures in different states cost different amounts. And
okay,
so you want to make sure that you're not setting yourself up. I get lots of clients sometimes and they'll come to me already and they'll have eight LLCs. And I'm like, why do we have eight LLCs? And they're like, I'm going to buy these and these properties. And I'm like, well, couldn't we have created the LLCs after we bought the property?
yeah,
Like, because we now have to pay fees for filing the returns, even if they don't do anything, you still have to pay for filing the returns. You still have to pay the state for having that. Like, these things kind of add up. And so you want to make sure you're looking at it full picture wise.
sure. Like you said, it's a strategy plan. Don't do it, then start thinking about it. Strategize and plan it out and execute the plan. Another good question from Eric, if I may. He's asking if I have several limited partners on a deal who provided capital for a property purchase, how does the cost seg benefit them? How is it spread across business financial partners in a property? For cash flow payouts monthly, but also cash out later when we refinance.
Cash flow payouts and refinancing aren't really the tax. That's different than tax, so it's not really my area. I will say when in terms of like loans and refinancing and everything like that, the depreciation is added back. It's not considered a deduction, and so but that would have been anyways whether you're doing a cost seg or not. What happens with cost segs is you get to accelerate the depreciation, and so on their yearly tax return they have a larger deduction. If you're doing it as like a limited partner type of situation, if you're just paying them out through commissions, that's a whole different other ball game. I would recommend, Eric, that you sign up for like a consultation and we can kind of go more into details about what is exactly happening. You also need to make sure that the property is there's enough, like that you bought it for enough and that enough money has gone into it so that it makes sense, right? If I have a property that I purchased for $300,000 and I did $50,000 of renovations, did I do a cost segregation study? I'm not probably there's not much to accelerate. So like that might not make sense. But if I bought said property for 300,000 and I put 500,000 into it, so yeah, now we can talk about it might make sense to do a cost seg. But I wouldn't be the one that would do the cost seg. What we always tell people, let's talk about it. I can tell you, I know when cost segs will make sense and not make sense. And then we go get a free estimate so that we can see how it gets evaluated. And then we plug and play and we can see, yes, this does make sense before you spend the money on getting the cost seg or like that, because again we want to make sure it makes sense. We don't want people to spend more money and then yes you got a tax saving but it costs more money to get said tax savings. Like at the end of the day we're trying to keep the most amount of money.
Of course.
So
Now, the cost seg that you mentioned, you hire is there like a subcontractor you guys hire that specializes in doing that? Is that how?
there's cost seg people. We know quite a few. I have obviously my favorites just because I like how we communicate. But yeah, there's tons out there. Some of them are very very cheap and some of them are astronomical. I always tell people, before you do the cost seg, before you hire them, if they won't give you a free estimate of how much you can accelerate, they give nice little forms, they're not worth it. They're not worth, what is the expression? Not worth their weight in salt or something. I don't know, whatever the expression is. Like, all the ones that are really good, and you need them to be good because later on you might need them if the IRS has questions or whatever, and so you do need them to be good for what they are. They will give you a free estimate. It doesn't take them long to get. They can do it 2 days to
Yeah.
give you a free estimate, and then that's when you apply and see.
Yeah. Well,
Um,
cool. Thank you guys for those questions. Keep them coming.
So let's talk about auditing, because that's everybody's biggest fear. Everybody's like, oh my God, am I going to get audited? I'm so, so scared. Could you be audited? Absolutely. It is an absolute fact. And sometimes we know we're going to be audited. Sometimes I have clients and I'm like, yeah, this is going to trigger an audit. But that's okay, because one, we are prepared for it. We know we're going to win the audit and it will be a zero change audit. And an audit is just the government coming around going, wait, I don't understand. This doesn't make sense. And if anybody's ever called the IRS or called their state tax agency, they know that there's a lot of dumb people there. And so for them to come around and say, like, hey, this doesn't make sense, I get it. You're not maybe the greatest in said situation. There are things that will trigger audits and will absolutely cause them. We need to make sure those things are worth it. If you're saving $100,000 and you're guaranteeing an audit, or you're pretty sure you're going to get an audit, but you saved $100,000 of tax, it's okay. Like, if you're doing something and not saving any money in tax, that's dumb. If you're doing something and saving $50 or $500 in tax and triggering audit, no, we don't want to do those. Those are the really, really knock put in head type of errors. Like, why are we doing those? So I want to talk about some of those areas that we see that people do that really frustrate the living daylights out of me. Okay, so one is excessive credits and deductions compared to income. So credits are a tricky, great, and amazing thing, but a little bit tricky for people because people mix credits and deductions up. And credits are the government agreeing to pay part of your bill or all of your bill. They're agreeing to pay XYZ amount of the bill. They'll agree to pay 7,000 of it. You'll get a $7,000 credit, and so that will take away 7,000 of your tax liability. Deductions are reducing your taxable income, and then they tax whatever your taxable income is. And so if you have a lot of credits, if the government's agreeing to pay your bill, they of course are going to look. They of course are going to be like, okay, let's just make sure that this is true. It doesn't mean that credits are bad. It just means we need to make sure we qualify for said credits. When COVID happened and lots of people were getting employee retention credits, people were doing the PPP loans, people were doing all kinds of things. Government's just like, here's money, here's money, here's money. But 3 years later, the government's like, wait, excuse me, sir, knock, knock, excuse me, Harvard, excuse me, Chipotle, can we see your numbers again? Oh, wait, your numbers don't make sense. You don't actually qualify. Run me my money back and interest and penalties. Like, that's how the government kind of operates. And so when there are credits, when the government's willing to pick up your tab, great, amazing. I want everybody to get as many as they qualify for. We just need to make sure that we qualify for them. The excessive deductions in comparison to income, this drives me insane. If you have quote unquote what you're calling a business and it has no income and you spent 30, 40, $60,000 on said business, it's not a business. It maybe will be a business, but you have no revenue. So it is not a business yet. So you don't really actually get to take a business deduction when it's not even a business. It's exactly right. It's probably a hobby. It's probably right. Or maybe it's going to be a business. I'm not trying to chop anybody's like hard work down, because there are definitely instances in people's lives where you have had a business or you currently have a business and you got a really crappy year because COVID, because of the strikes, just because of the economy, because of whatever the reasons are. And so it doesn't, in those instances, it doesn't mean don't take the deductions. I'm not telling people not to take their deductions. I'm telling people to make sure they're structured correctly so that they're not going to trigger an audit for where it might be just more advantageous. We can get those deductions if we spread it over time. Maybe we need to amortize something. Maybe we need to categorize it in a different way. Maybe you need to be structured a little bit differently. And I'm going to talk a little bit more about the structures. But you need to look to see how much you're doing and how much. It doesn't make sense for it to say, yes, I have $10,000 of income and $70,000 of expenses. Sorry, that's not going to work. Or for people to say, I have $10,000 of income and 9,000 of it goes to meals. Huh? Like, how, how you figure, boo? Like, that's not the case. And you're going to attract attention, and you need to really look to see, is me being really aggressive in my deductions from meals really worth it? That $9,000, well, I'm only going to get half because meals are only at 50%. Am I really saving myself so much money? That $4,000 deduction is probably saving you 600 bucks and guaranteeing you an audit. Like, does that really make sense? And so you really need to look at how you're doing things. Um, we'll talk about the common types of deductions a little bit later and how some people could be labeling things great. Missing and underreporting income is you're just lying. You're just lying. That's all it is. And you're getting audited because you lied. Like, the government knows you lied. I know you lied. But you know you lied. You're not telling the truth. Omission is a lie. And they are going to say, cool, let's prove that you're lying, because that's what government likes to do. I always remind people, because I get people that talk about, like, oh, I have rentals, blah, 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 and then, like, my father-in-law is one of them, and I got this ADU out back, but I don't want to talk about anything that's dealing with those two things. One, you're probably hurting yourself. Two, you're asking for the people that are giving you the money to, one, not be audited, and two, not to take their rightful deductions. And then also you need to remember the penalties for doing, let's call it, an aggressive approach. If you're super, super aggressive with your deductions, the highest consequence for being wrong with your deductions is penalties, is money. That is the highest consequences. The highest consequence for not reporting income is jail. When they've got the super crazy criminals that they can't catch, they call the tax agents to come in, and that's how they catch them. And then they put them in jail for decades. So, not reporting income, lying on your tax return is not something I recommend ever, 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 ever. And that is also probably hurting you. 9 times out of 10, I get clients that trying not to talk about this AD, trying not to talk about the father-in-law who rents the house. Then we find out I make them, because I'm not losing my license. I make them report it, and they realize at the end of the day, because of depreciation, because it's a rental, you're actually hurting yourself, and you could be taking a loss that you weren't taking a loss because you thought you were going to have to pay tax. And no, just report your income. Refundable credits. Remember, credits is the government saying, I'm going to cover this portion of your tab, right? I'm going to cover it. So the government says, I'm going to cover $7,000 of your tax liability. But we do your taxes, your tax liability before your withholdings, before anything, isn't $7,000. It's $3,000. The government said they'd cover seven of it. You have a $7,000 refundable credit. They are now going to give you $4,000. If you've ever gotten a refund from the government, you know the government doesn't like giving up money, like, ever, for any reason. They don't like doing it. And so if they are going to do it, they are very, very much going to pay attention to see who's going to do it. And also the people, the type of person that qualifies for refundable credits, just in general, not 100%, but in general, is going to be lower income people. And so sometimes they like to take a little bit more risk about doing things, and they obviously aren't going to pay for people to help them because they can't necessarily afford to get the education to know, like, hey, can I qualify? I need this and that or whatever, about things. The other thing is round numbers. Round numbers. When I ask for people for their P&Ls and I see they made $100,000 of income, fine, whatever, and $50,000 in auto and $20,000 in marketing and $6,000 in supplies. That never happens. You never buy anything for $1,000. You never buy anything for $1,500. You never, ever, ever, ever. And even if you did, you bought one thing, but in that category, there's other things that should be in there. And so there'll never be a round number. It's super rare. I look at numbers all day long. And it is super, super, super rare for you to have round numbers. And so that means you didn't do the work that is required for you to do your return. And so the government's like, cool, great, we'll force you to do it because we don't believe you, because you didn't do the work and you're saying you did. And so they will force you to do it. And that's the first thing they ask you to do when they force you to do it is give bank statements. And they go through, let's talk about all that income. Let's go through it. So spending the time to look at your stuff, organizing it. There's so many tools out there nowadays that there's no reason for you to not spend the time. Like you're just being lazy and you're going to hurt yourself 8 million times over because you are being lazy, and nobody likes that. The types of companies that, okay, we've got partnerships, we've got S Corps, we've got C Corps, and we've got individual returns. Now, the corps or C corps are going to be the ones that are audited the most. Why are C corps audited the most? Well, C corps are the only type of entity that pays its own tax. Partnerships, S corps, and then personal returns, single member LLCs, sole proprietors, all that, whatever. That's all in your personal return. All of these things are passed through. They don't pay tax. I mean, they pay a little bit to the state, but they don't pay income tax. The personal return is what pays the income tax. Your partnership passes through, the S corp passes through, and all the tax goes out to your personal return. C corps, what happens is corporation will pay tax, and then if you use any of that money, you will now have to pay a personal income tax on the money that you took out for personal use. And so that's basically double taxation, right? If I own my own C Corp and my C Corp is paying tax, me paying tax, and then I'm using that money for my vacation in Cabo or wherever I decided to go, and now I have to pay tax because I pulled money out of the corporation, I'm paying tax twice. And so that is double taxation. And so there's been a way that older people have used for quite a long time to avoid that. And it's called loans to shareholders. They say, like, oh, you're doing loans. The government has gotten equipped with this. They understand this. They've put in forms that help stop that very much because you're not doing a loan. You're not paying interest. There's not a timeline of when it needs to be paid back, and it is not notarized. And that is not a loan. It is you, the owner, using the money, which means you should have double taxation. And so this is an easy audit for them. It's an easy peasy audit. That's why it's so highly audited. So many people were doing it. It's now a lot of people really aren't doing it because that's just dumb. Partnerships and S corps are audited less than personal returns that are Schedule C's or single members or whatever it may be, Schedule E's, whatever it may be, because just in general, you have to provide more information. Me, as the tax filer, has to provide more information than I would on a personal return. I have to balance the return. I have to show the money flowing in and out. I have more information where I have to say where. I have to talk about my shareholders. I have to talk about who worked for the company when, how many W-2 employees. There's more information that goes into an S corp or to a partnership return. This is why it costs more when you're filing these types of returns. Like we charge more money because it's more work. If you have that business, remember I said there's that business way back when where you had a bad year and you only brought in 10,000 and you have $50,000 or $60,000 of expenses. I have more proof of that. I can show proof before they have questions if it's in an S corp. So be just by the nature of the return. Even if you wanted to add that proof to the personal return, there's nowhere to do it. It's not like I can staple pages to the personal return. Like they don't accept additional bits of information. They only accept the required amount of information on the personal return. Thus, you have people getting audited more on personal returns. And then also in addition, you've got like Uber drivers and people that are just like, hey, I made $15,000 here. I want to do more things that are just like a little bit less educated in tax law and tax strategy and take a little bit more risk in terms of those things. And so personal returns are going to be audited quite a bit. And so you should be very conscious of how aggressive and where you get aggressive on personal returns, just on a risk versus value type of situation. The last type of people that we're last type of thing we're going to talk about in terms of audits is the type of person that's being audited. We've got low income earners and high income earners. They're audited the most. Low income earners are audited the most because, one, we talked about refundable credits. Those are the people that qualify for refundable credits. I never qualified for a refundable credit. I would love the government to give me money. But those are the people that are qualifying for them, and they can't necessarily afford to have somebody make sure they're doing it correctly, make sure they're not claiming it twice, make sure two people aren't claiming it. They don't have that money to do that. And so of course they're going to be audited because it's, you got to think of it very much like a child versus an adult type of situation. The government looks at them kind of as children because their tax filings are pretty basic and pretty simple, and their knowledge of the tax codes and things like that is pretty simple and pretty basic. While people that make more money, you've been with it a little bit more, you know a little bit more of the ins and outs, and then you've hired people that will tell you, hey, this is good, this is bad. And so you're just more knowledgeable. Now, high income earners, why are they getting audited? They have the most resources, they make the most money, they probably are paying maybe the most in tax, maybe. Um, uh, it's because they do stuff. They do stuff. They do a lot of stuff. It's fun. They're in the back of the tax code. They're in the page in the page 1,899.5. They're not in page 1 through 2. And so, yes, they know they're going to be audited. They're prepared for audit. Trump dismantled so much of the audit department in the IRS. Why? Because he's been audited for the last 40, I think it's 42 years. Every year he has been audited for like the last 42 years because he does stuff. I don't want to comment on if it's good or not good, the stuff he does, but I do. That man is a very aggressive taxpayer, or lack of taxpayer, and thus he's going to attract attention. And it doesn't mean just because you get audited, you did something wrong. It just means maybe you need to provide some more information. When we do things that saves people $70,000, $100,000 in tax, and I know there's going to be an audit, I will prepare you. I will make it so that, great, we know there's going to be audit. We need to make sure we have all of our ducks in a row. We need to make sure we're doing all of our due diligence. So when it comes around, here you go. It's going to be hopefully an easy audit, but at the end of the day, it'll end up being a zero change audit. And so don't be afraid of audits. Don't be afraid of credits. Don't be afraid of deductions. Don't be afraid of any of these things. Don't be afraid to do something on a personal return or to have your S Corp. Don't be afraid of any of these types of situations. You just need to make sure that you're doing it with the right knowledge and you're preparing yourself correctly for how that return should be done. I'm going to quickly talk about the top 5 deductions. Then I'm going to open it up for questions. I want to talk about the top 5 deductions because sometimes people get kind of confused. Meals and advertising expenses, one of the hugest deductions that are going to be on there, especially for people dealing in real estate. You operate in a world online and in person. You're promoting, if you're renting out places, you're advertising online, you're advertising in person. If you're a broker, oh my God, there's so much going on. A lot of times when you're doing events or you're taking people to dinner, yes, you're like, oh, well, it's also advertising, it's also marketing, right? The educational things, they can all fall into some of these buckets. And so sometimes you really just need to double check how you're categorizing things, especially when one bucket is looking a little heavy. Personal and professional expenses. I'm in my office. You can look around me and see I have a TV in my office. I have a computer here. I have a laptop that I also use for work. I have an office in my house. There's a TV there. All of these things cost me money, and they're all deductions that you're going to use because you ask yourself, are you using it for business? This TV I'm using for business, and it's 100% used for business because it's in my office, right? So yes, I'm using it for business. How much of it is used for business? 100%. I'm taking that deduction 110 million%. Car expenses. Cars are here in California, we drive more than the average American. Average American drives 10,000 miles a year. We drive about 12,000 to about 12,200. So also our cars are more expensive. And if you also just drive more, you have to understand that the mileage that you're taking, if you decide to count miles, that's a national average. They're putting in the people in Iowa and the people in even New York City, like, that don't even have like as much miles as on their things. That's a national average. So maybe if you're in a high state like California where gas is high and stuff, it might be better for you to take straight expenses. Also, if you're just using your car a lot, or if your car is older, it might be better for you to take straight expenses depending on how much stuff is going into your car. And people forget car washes, wrapping your car, what do they call it? Whatever you do at the dealership when they do stuff with your car, tinting your car, all of those things count. If you got a dent and all of that stuff is going to be deductible expenses if you're using your car for business. And so it's not just gas and miles. A lot of people just focus on like gas and miles, and there's more to that. Legal and professional, this is a personal thing for me because when I look at people's P&Ls and I don't see my expense, I'm like, where's the money you paid me? And they're like, oh yeah, I forgot. And I'm like, how do you forget that? That's a business expense. When you pay for professionals, it's not just the lawyers, it's the notaries, it's the transaction coordinators, it's the accountant, it's uh, everybody that you're hiring. If you're not paying on straight commission and you're hiring the assistant, if you got somebody in a different country to help you, like a virtual assistant, all of those things count and they're all deductible because, again, ask yourself that first question: am I using it for business? If the answer is yes, that's why I hired them. I am using them for business. That answer is yes. The marketing professional, the what is it? SOIS, SEO, the SEO people, like all of those things are going to be deductible and you should not forget them. Property deductions, whether if you own, it's a little bit better. But whether you rent or you own, whether the property is a business property or the property is a personal property, a lot of expenses, just like your car, it's your biggest asset that you own, most likely. It can be included, it can be taken into account for it, and there's just different ways to account for it. But property can be taken on the personal side or it can be taken on the business side. There are a lot of changes that are going to happen this year. The tax code will be changed regardless of the president that we have. It was going to be changed. That didn't matter because when tax code is written by politicians, and politicians, when they don't want to have it all go through Congress and everything like that, they put a timeline on it. They say this is in effect for the next 5 years, this is in effect for the next 15 years, etc. And so then those things expire. And this year, a lot of stuff is expiring from what Trump did the first time he was around. There's going to be changes. You hear a lot of things on the news. It takes a lot of people before these changes come into effect. So relax, because a lot of them are all over the place. And the Section 179, the ability to take bonus depreciation 100% in 1 year, has been with the Ways and Means Committee for 3 years. It has been proposed, approved by the Senate, and sitting with the Congress for 3 years. 3 years. So things take time. Just because they're being proposed this year right now doesn't mean it's going to go in effect, or maybe it'll go in effect into 2026. So I'm telling everybody, because I'm getting the calls and the emails going, what if, stop the what ifs. We have no control over the what ifs, and they're not happening right now. I know I talked quite a bit. I talked a lot, but I definitely wanted to open it up to any questions that you have. And if you guys want to set up a consultation, please feel free, because really, again, your tax returns are tools and assets. And if you sharpen them, you can exact such great benefits for yourselves.
This is awesome. Yeah, if you have any question, this is the time. We'll take some questions here. Thank you so much, Nicole. This is very, very helpful information. A lot of cool nuggets, some new things that I haven't heard before. So thank you for sharing this.
Of course.
Um,
Everybody, as accountant's favorite answer is like, it depends.
it depends.
So
Yeah.
I have a question, and it might be very specific.
Sure.
I know that we were going over the top deductions, and one that I constantly see is like for your automobile. Depending on and I don't know if it does change versus C Corp, Sole Prop, or S Corp, but a lot of people, I know the mileage is a thing, but what about your car payments?
So that is going to depend on how you're structured. If your structured is if your structure is like a personal, like it's on a Schedule C on your personal return, you're not going to be able to take your payment. Technically, you don't get to take car payments really anywhere unless it's a S corp. And then we're going to talk about how much you're using it for business, and then if we're able to take the full amount. If you financed it, we'll take the value of it. If you lease it, you can take the payments in the years that you are using it. If it's an S corp, if you're talking, it's just a Schedule C that is technically included inside miles. So then it's going to go: are you itemizing? Well, it's not itemizing. Are you taking direct expenses? Or are you taking not direct expenses? And so we have to see how much of your direct expenses are going to be counted before we can get those in.
Okay, because then the other one that I've constantly seen on people's books is like they will be doing the mileage at the end of the year, but then they're tracking fuel expenses.
Perfect. That's exactly what you want. You want people to do both. So if you're Schedule C, let's just imagine we're a Schedule C or a single member. Because if you're not a single member or Schedule C, there's no reason for you to track miles because you're always taking direct expenses. And so if you're Schedule C or a single member, you're either going to take miles or you're going to take direct expenses. Direct expenses is going to be the gas. It's going to be the car washes. It's going to be direct things. If you got in a car accident, the fixing of the car, those are going to be direct expenses. Indirect expenses is going to be the buying of the car, whether it's financed or leased. And
Hmm.
before I know if I'm taking direct expenses, I need to see what that number is. If my direct expenses is $10,000, and if I do miles, my miles comes out to $11,000. That my indirect expenses don't even matter because I'm taking miles. If my direct expenses come out to $10,000, and when I do miles, it comes out to $8,000. Great. I'm going to take my $10,000 of direct expenses, and I also will get a portion of my indirect expenses.
Oh, okay, because that's what I was always worried about, that it was a double dip situation. I'm like, you can't do both. I'm pretty sure you can't do both, but I'm not an
You can't, but
accountant.
you should track both. Right. Yeah,
Okay,
yeah. You
that
can't,
makes
but you should
sense.
track.
Okay, and by the way, Nicole, this was a very wonderful presentation. I got on late, but it was very engaging from the point that I got on. So making
Thank you.
taxes fun.
Thank
That was
you.
awesome.
Yeah, I love taxes very, very much. I know it's weird, but it is fun.
Yeah, I appreciate you coming on, Charity, and thanks for the questions. If anybody has any last minute question, please bring it up. Otherwise, we will end it here. Nicole, thank you again so much for being on. Again, stay tuned. Nicole will be on the podcast as well, and I will push to have her back on the webinar because the information she has, there's only so much you can share within an hour. So, thanks again
Yeah.
for being on. We appreciate you guys, what you guys do to our clients, for us, and for the community here in Glendale as well. So, until next
No
time, you guys
problem.
have an awesome. Oh, it says, what is the email for Nicole? You want to drop your email in the chat real quick?
Yeah, I'm typing it right now.
Perfect. Sweet.
Nicole.green at Robert Hall Taxes.
Awesome. And if you guys have any questions, after we get off, just feel free to reach out to me and my team, and we'll connect you with Nicole if need be. And you guys have an awesome day. Thank you so much.
Bye, everybody.